Hey everyone, welcome back. Today we're tackling something I know a lot of you are interested in. Building a portfolio of high-yield dividend stocks that, get this, pays out every single month.
Yeah, the dream, right?
Yep.
Monthly income, like clockwork.
Exactly. But we all know it's not as simple as just grabbing any three stocks with the juicy yield, so we're going to break it all down.
We'll get into this strategy and some real examples, too. We're actually using a Motley Fool article as our guide today. Came out November 7th, 2024, so pretty recent.
Oh, perfect timing. And they suggest three companies to kick off this monthly dividend plan. We've got Kraft Heinz,
The classic.
then the one and only Procter Gamble,
Can't go wrong with those household names.
and then things get interesting. Toronto Dominion Bank. Now, they've had some legal trouble recently, which we'll definitely dig into.
Yeah, the article calls TD a potential bad news buy. Risk and reward all in one.
So much to unpack there. But first, I think it's important to understand WHY we can't just pick any three high yielders and call it a day.
Right, because it's not just about the yield itself, it's about the timing of those payouts. It's got to be strategic.
Okay, so enlighten us. What's the secret sauce to getting dividends every month?
It's all about staggered dividend payout schedules.
Yeah.
Think of it like a relay race. One company pays out, then the next one's ready to go.
Got it. So instead of waiting around for 3 months, you're getting something every month. That's the beauty of it. Okay, let's start with Kraft Heinz. KHC, for those following along at home, I mean, come on, everyone knows them.
Oh yeah, Kraft mac and cheese, Heinz ketchup, Oscar Mayer, the list goes on. Pantry staples.
Right. But here's the thing. Haven't they been struggling lately? I feel like I've seen some headlines.
They have. Inflation's hitting hard, cost of ingredients going up, and we're seeing more people buy those cheaper store brand products.
Makes sense. So what does that mean for our beloved ketchup and mac and cheese empire, bottom line wise?
Their sales and earnings have definitely taken a hit. But, and this is important, their free cash flow is still strong. Over $3 billion last year.
Wait, so even with those challenges, they're making enough to keep paying dividends. Is that why the article still recommends them?
That's a big part of it. Plus, their free cash flow actually exceeds what they're paying out in dividends, which is reassuring.
Okay, so they're not stretched too thin. That's good. And what's the dividend yield looking like right now?
It's sitting at 4.8%.
Not bad at all. All right, next up is Procter Gamble, PG. I bet they have even more household names than Kraft Heinz. Tide, Pampers, Gillette, Head and Shoulders. Seriously, do they make anything we don't use?
They probably make the soap you use to wash those products off with. But seriously, P&G is the definition of a diversified portfolio.
Which must be why they've got such an amazing track record with dividends, right? Like legendary status.
We're talking 68 years. Yep, you heard that right. 68 straight years of dividend increases. P&G's a dividend king.
Wow, 68 years. Okay, we have to come back to what makes a dividend king later on. But real quick, what's their current yield?
It's 2.4% right now.
Lower than Kraft Heinz, but I'm guessing that consistency makes them attractive for long-term investors, right?
Absolutely. And stability is often what people are looking for when they think dividends. Okay, now for the stock with the really intriguing story. Toronto Dominion Bank, TD. This is where it gets juicy.
Lay it on us. Big problems, but maybe a big bargain.
So they got hit with a $3 billion fine recently.
Whoa. That's billion with a B. What happened there?
Money laundering failures, major oversight issues, didn't prevent it like they should have. And on top of the fine, there are now limitations on their asset growth.
Okay, so 1-2 punch right there. But the article still thinks they're a good buy. How does that work?
Well, this is where the bad news buy concept comes in. All this negativity has pushed their stock price down, but their dividend yield is at a tempting 5.3%.
So it's like they're on sale, but with a high payout? I can see the appeal, but man, that's risky.
Definitely requires some serious research. You got to be confident they can bounce back from all this, but that high yield IS enticing.
Before we get too deep into analyzing each company, let's back up for a sec. How do their dividend payouts actually work together to make this monthly income thing happen?
All right, so picture this. Kraft Heinz pays out in March, June, September, and December.
Boom, 4 months covered already.
Then Procter & Gamble steps in. Their payments are in February, May, August, and November.
Okay, 8 months. I'm starting to see how this works. It's like clockwork.
And to round it all out, Toronto Dominion fills in the remaining gaps, paying out in January, April, July, and October.
Wow, so with just these three, we're literally getting a dividend check every single month. This is incredible.
It is. But remember, this isn't just about these specific companies. There are tons of dividend stocks out there. It's all about finding the right combination with those staggered payout schedules.
Okay, my mind is officially blown. But let's not get ahead of ourselves. We've talked about the big picture, now let's zoom in. What are some key things to consider before we even think about adding Kraft Heinz to our portfolio?
All right, let's unpack Kraft Heinz a bit more. We know they're facing those challenges with inflation and the rise of store brands, but there's more to it than that.
Oh, do tell. Spill the tea.
Well, for one, their cost-cutting measures have worried some analysts. Some say it's affecting product quality, maybe even slowing down innovation.
Oh, so it's like a short-term gain, but could hurt them in the long run.
Potentially.
Yeah.
And then there's that mountain of debt they took on with that big merger back in 2015. Still dealing with that.
So not all sunshine and roses, but their free cash flow is still looking pretty good, right? Does that mean those dividends are safe for now at least?
That's the million-dollar question, right? The strong free cash flow is reassuring, but it's not a guarantee forever. Things can change.
So we can't just assume those dividends will keep coming in no matter what. Got to keep an eye on things.
Exactly. We need to dig deeper. Look at their overall financial health, not just one piece of the puzzle. How much debt they have, their profitability, their plans for the future, all of it.
All right, I'm sensing a deep dive coming on. So if we're playing financial detective with Kraft Heinz, what are the red flags we're looking for specifically?
Good question. First, are their sales actually improving, or are they still losing ground to those cheaper competitors? Can they raise prices without losing customers?
Makes sense. Got to stay competitive. What else?
Second, keep a close eye on that debt. Are they managing it well, paying it down, or is it becoming a bigger and bigger problem?
Okay, responsible debt management. Check. Anything else?
And lastly, we've got to assess the management team. Are they making smart decisions, investing in innovation, keeping up with those changing consumer tastes?
So many factors to consider. I'm starting to feel like a financial Sherlock Holmes. All right, let's move on to Procter Gamble. They seem like a much safer bet, right? I mean, they've been increasing their dividend for almost 70 years.
They do have that impressive track record, and their massive portfolio gives them some serious resilience. But even the giants can face challenges.
Wait, are you telling me that even Procter & Gamble isn't a sure thing? You're shattering my worldview. What are some potential risks we should be aware of?
Well, even the biggest brands can lose their shine. Consumer preferences change, new trends emerge, and if P&G doesn't keep up, they could lose ground.
So even with their incredible history, they can't just sit back and relax. Got to stay ahead of the game, huh?
Exactly. Innovation is key. And then there's always competition. New companies popping up, trying to disrupt the market. They can't get complacent.
This is really making me rethink how I view investing. It's so much more dynamic than I thought. It's not just about picking stocks and hoping for the best. It's about ongoing research, staying informed, constantly reevaluating your choices.
It's a journey, not a destination.
Mm-hmm.
And like any journey, it's best to be prepared.
Well said. Okay, I'm ready to tackle our final puzzle piece, Toronto Dominion Bank. High risk, high reward potential. Break it down for me. What does it really mean to be a bad news buy?
All right, so you're essentially going against the crowd. Everyone else is panicking, selling off their shares because of those negative headlines, driving the stock price down.
So you're being brave, going against the flow.
In a way, yes. You're betting that the market has overreacted, that the company's still fundamentally sound despite the bad news, and that the stock price will bounce back eventually.
I can see how that could lead to some serious gains, but $3 billion in fines and limitations on their growth? That's not exactly a minor setback.
No doubt about it. That's why research is key here. You got to understand the root of the problem. Is this a temporary mess they can clean up, or is it a sign of deeper issues, something that'll haunt them for years?
So we're trying to determine if the bad news is actually as bad as it seems. Could be a bargain, could be a trap.
Exactly. And even if the company looks good after your research, you got to consider your own risk tolerance. Bad news buys can be volatile. Are you okay with potentially waiting a while for things to turn around?
Good point. It's not just about finding a potentially undervalued stock. It's about making sure it fits your personal goals and comfort level.
Absolutely.
Yeah.
Investing should be a personalized strategy, not a one-size-fits-all approach.
I love that. Okay, I think we've laid a great foundation here. We've explored the power of monthly dividends, the strategic timing, and even dipped our toes into the world of bad news buys.
We've given our listeners a lot to think about.
For sure. But before we let everyone go, let's bring it back to basics. What does all this mean for someone who's just starting out with investing? What are the key takeaways they should be thinking about?
I'd say the biggest thing is, don't put all your eggs in one basket. Diversify. Spread your investments across different companies, industries, maybe even other types of assets.
So even if we love this idea of monthly dividends, we shouldn't just focus on these three stocks. Keep it balanced.
Exactly. Don't get tunnel vision. Think big picture. Second, remember that just because a company has paid dividends in the past doesn't mean it's guaranteed to continue. Always do your homework.
So no matter what, research is key. Due diligence, all that good stuff.
Absolutely. And always be aware of fees. Whether you're using a brokerage account, a mutual fund, an ETF, whatever, there are costs involved. Make sure you understand them.
Fees can really eat into your returns if you're not careful.
They can. And one last thing, don't forget about taxes. Dividends get taxed too, and the rules can be a bit tricky. Do your research or talk to a tax pro if you need to.
Taxes, the one certainty in life. Well, I'm feeling a lot more confident about navigating the world of dividend investing thanks to you.
Glad to hear it.
Any final words of wisdom for our listeners before we sign off?
Investing can be incredibly rewarding, both financially and personally. Enjoy the process, stay curious, and keep learning.
I love that. And remember, our deep dives are just the starting point. Take what you've learned, do your own research, and build a portfolio that works for you.
Exactly. Take control of your financial future.
Well said. That's a wrap on part 1 of our monthly dividend deep dive, folks. This is so much more than just picking stocks and hoping for the best. Okay, I think we've laid a great foundation. Now let's roll up our sleeves and look at the numbers. We've talked about the general challenges and opportunities, but I'm ready to get into the nitty-gritty financials of each company. Where should we start?
Let's revisit Kraft Heinz. Their latest earnings report gives us a good snapshot of their current situation.
Perfect. Refresh my memory. What kind of numbers are we looking at?
As we touched on earlier, sales have been declining. In the first 9 months of this year, they brought in $19.3 billion, down 2.6% compared to last year.
Not a great sign. What about their profits? Are they still in the black?
Yes, but earnings have taken a hit, a 71% decline to be exact.
Whoa, 71%. That's massive.
It is, but it's important to note that this figure includes some significant one-time charges called goodwill impairment charges. If we exclude those, their profits are down a more manageable 17%.
Okay, so not quite as dramatic as it first seemed, but still a 17% drop in profits is nothing to ignore. What's the story behind these impairment charges?
Goodwill impairment charges essentially mean the company has had to lower the value of some of its assets on their books. This often happens after a merger or acquisition when the acquired company doesn't perform as well as expected. For Kraft Heinz, it's likely related to their mega merger back in 2015.
So they're still dealing with the fallout from that deal.
It appears so. These charges suggest that some of the brands or businesses they acquired haven't lived up to their initial valuations.
Okay, sales are down, profits are down, and they're dealing with some accounting adjustments. But what about that all-important free cash flow?
Here's the silver lining. Despite these challenges, Kraft Heinz generated over $3 billion in free cash flow in the last 12 months.
$3 billion. That's more than enough to cover their dividends, right?
Absolutely. They've only paid out about $1.9 billion in dividends over that same period.
So even with the challenges, they're generating plenty of cash to keep those dividends flowing. That's good news for income-focused investors like our listener. But what about the bigger picture? Can they keep this up long-term?
That's the question every investor should be asking. While free cash flow provides a buffer for now, it's not a guarantee of future dividend payments. Remember, free cash flow isn't static. It's affected by a lot of things: sales expenses, investments, debt payments, the list goes on.
So we can't just assume those dividends are a sure thing forever.
Exactly. We need to look beyond the current free cash flow and assess their overall financial health and their long-term strategy.
All right, I'm up for the challenge. What are some of the key factors we should be looking at when evaluating a company's ability to maintain its dividend?
First, delve into their sales trends. Are they turning things around and gaining back market share, or are they continuing to lose ground to those private label competitors?
So sales growth is crucial. What else?
Next, scrutinize their debt. They're carrying a hefty amount, which impacts their profits and limits their flexibility. Are they making progress in paying down that debt, or is it growing?
We're looking for signs that they're being financially responsible, right?
Yeah, exactly. Responsible debt management is key.
Makes sense. What else should we be watching?
Pay close attention to their management team. Are they making strategic decisions, investing in innovation, and adapting to changing consumer preferences? Are they communicating their vision effectively to investors?
Okay, so it's not just about the numbers, it's also about the people making the decisions. I'm starting to realize how much goes into being a smart investor.
It's definitely more complex than just picking a stock and hoping for the best. It's about truly understanding the business, analyzing their financials, evaluating their leadership, and constantly assessing their long-term potential.
Well said. Okay, let's shift gears and look at Procter & Gamble. They seem like a much more stable company. What do their financials tell us?
On the surface, they appear to be navigating the current environment quite well. Their most recent quarterly report, which covers the period ending September 30th, paints a relatively steady picture.
I'm all ears. Give me the highlights.
Their net sales for the quarter were $21.7 billion, down just 1% compared to last year.
A 1% decline, that's practically flat. Quite a difference from Kraft Heinz's double-digit drop.
Indeed. And even more encouraging is their operating income, which actually increased by 1% to just under $5.8 billion.
So even with a slight dip in sales, they're making more money. How is that possible?
It indicates they've been able to manage their costs effectively and maintain their profit margins even as they face some challenges.
That's impressive. It sounds like they're running a tight ship. But hold on. Didn't we say earlier that even giants like Procter & Gamble can stumble? Are there potential risks lurking beneath the surface?
You're absolutely right. Past performance doesn't guarantee future success.
Yeah.
Even with their incredible history, they're not immune to challenges.
Okay, give me the reality check. What are some of the things that could derail their success?
One thing to consider is that their vast portfolio of brands, while a strength, also presents a challenge. It gives them diversification and reach, but it also makes them vulnerable to shifting consumer preferences.
I see what you mean. If one of their major brands falls out of favor, it could significantly impact their bottom line.
Precisely. They need to constantly innovate, adapt to changing trends, and ensure their brands remain relevant and appealing to consumers.
It's a never-ending race to stay ahead of the curve. What else should we be looking for?
Another key factor is competition. The consumer goods market is incredibly competitive, with both established players and new disruptive companies vying for market share.
So even a giant like Procter & Gamble can't afford to rest on its laurels.
Exactly. They need to constantly defend their market share, invest in research and development, and continue to innovate.
This is giving me a much deeper understanding of the complexities of investing. It's not about blindly buying and holding forever, even with seemingly safe companies. It requires ongoing attention and analysis.
You're absolutely right. Investing is a dynamic process. It requires continuous learning, adaptation, and reassessment.
Well said. Okay, I'm ready to tackle our final company, Toronto Dominion Bank. They're facing significant challenges, but potentially offer a high-yield opportunity for those willing to take a calculated risk. Let's break down their situation.
All right, let's delve into the world of banking and the perfect storm Toronto Dominion is currently weathering.
Give me the rundown. What's at the root of their troubles?
Well, as we mentioned earlier, they were recently hit with a massive $3 billion fine for their failure to prevent money laundering. This is a significant blow both financially and to their reputation.
Ouch, that has to hurt. What exactly happened?
While details are still emerging, it seems they didn't adequately monitor transactions and report suspicious activity, allowing criminals to launder money through their accounts.
So it's a compliance issue, a failure to follow the rules.
Precisely. And the consequences are serious. On top of the hefty fine, they're also facing limitations on their asset growth, which could restrict their ability to expand their business in the near future.
A double whammy. It sounds like they have a lot of work to do. But isn't this where the bad news buy opportunity comes in? Their stock prices dropped, right?
Exactly. The negative news has made investors nervous, driving down their stock price. And as we know, a lower stock price means a higher dividend yield.
So for those who believe that Toronto Dominion can recover, this could be a chance to buy in at a discount and lock in a good dividend yield.
That's the thinking behind a bad news buy. You're essentially betting that the market has overreacted to the bad news and that the company's long-term prospects are still solid.
But that's a big if, isn't it? These aren't small bumps in the road. We're talking about billions of dollars in fines and limitations on their growth. How can we evaluate whether they're capable of bouncing back?
You're right, it's a calculated gamble. Thorough research is absolutely essential. We need to carefully analyze their financials, assess how their management team is responding to this crisis, understand their plans to fix the compliance issues, and look at their strategy for dealing with those growth limitations.
So it's not just about looking at the current dividend yield. It's about understanding their ability to maintain those dividends over the long haul, even with these obstacles.
Exactly. We need to figure out if this is a temporary setback that they can overcome or a sign of deeper systemic problems.
I'm really starting to understand what it takes to be a successful investor.
Yep.
It's not about chasing quick profits or jumping on the latest trend. It's about understanding businesses, analyzing financials, carefully assessing risks, and making well-informed decisions based on solid research.
You've got it. Investing is a journey of continuous learning, adaptation, and reevaluation.
Absolutely. Okay, I think we've done a great job of breaking down these three stocks and exploring the idea of building a monthly dividend portfolio. Before we wrap up, are there any other important points our listeners should keep in mind as they start their own dividend investing journey?
That's a great question. Let's recap some key takeaways from our deep dive today. First and foremost, diversification is key. Don't put all your eggs in one basket. Spread your investments across different companies, industries, and asset classes to reduce your risk.
So even if we love this idea of monthly dividends, we shouldn't just focus on these three stocks. Keep it balanced.
Exactly. Don't get tunnel vision.
Yeah.
Think big picture. Second, remember that just because a company has paid dividends in the past doesn't mean it's guaranteed to continue. Always do your homework.
So no matter what, research is key. Due diligence, all that good stuff.
Absolutely. And always be aware of fees. Whether you're using a brokerage account, a mutual fund, an ETF, whatever there are costs involved, make sure you understand them.
Fees can really eat into your returns if you're not careful.
They can. And one last thing, don't forget about taxes. Dividends get taxed too, and the rules can be a bit tricky. Do your research or talk to a tax pro if you need to.
Tax is the one certainty in life. Well, I'm feeling a lot more confident about navigating the world of dividend investing thanks to you.
Glad to hear it. And you know what? Investing doesn't have to be a solo mission. There are tons of resources out there to help you on your journey, books, articles, websites, other podcast financial advisors, the list goes on.
So true. All right, we've covered a lot of ground today. We explored the exciting world of monthly dividend portfolios. We put three specific stocks, Kraft Heinz, Procter Gamble, and Toronto Dominion Bank, under the microscope. And we talked about some crucial investment principles like diversification, due diligence, and the need to stay informed.
We've given you the tools and knowledge. Now it's your turn to build something great.
I love that. It's like we've handed our listener a blueprint, and now they get to design and build their own financial future.
Exactly. Take this information, apply it to your own research and due diligence, and craft an investment strategy that aligns with your personal goals and risk tolerance.
This has been such an insightful deep dive, but before we let our listener go, I want to circle back to that bad news buy strategy we discussed. It seems particularly relevant in today's volatile market.
It's definitely a strategy that requires a certain mindset. You need to be comfortable with uncertainty and have a strong stomach for volatility. But it can be a powerful tool for investors who are willing to do their homework and bet against the crowd.
So for our listener who's intrigued by the potential of bad news buys, what are some key things to keep in mind? How can they separate the genuine opportunities from the potential traps?
That's a great question. It's all about asking the right questions and digging beneath the surface. When you see a company facing negative news and their stock price is taking a hit, the first step is to understand the root cause of the problem. Is this a temporary setback, something they can recover from? Or is it a sign of deeper systemic issues that could plague the company for years to come?
So it's about figuring out if the bad news is truly bad or just a temporary blip on the radar.
Precisely. You need to assess the severity and long-term implications of the issue. Look at their financials, their debt levels, cash flow, and profitability.
Yeah.
How is their management team responding to the crisis? Do they have a clear plan to address the problem and get back on track? Are they communicating transparently with investors?
So it's not just about blindly buying a stock because it's cheap. It's about carefully evaluating whether the company has the resilience and leadership to overcome the challenges they're facing.
Exactly. You're looking for signs of strength and a clear path to recovery. And remember, even if the company seems promising, you need to consider your own risk tolerance. Bad news buys can be volatile, and it might take time for the company to turn things around. Are you comfortable with that level of uncertainty?
That's such an important point. It's not just about finding a potentially undervalued stock. It's about making sure the investment aligns with your personal financial goals and risk appetite.
Absolutely. Investing should be a personalized strategy, not a one-size-fits-all approach.
Well said. I think we've equipped our listener with a solid framework for evaluating bad news buys. Before we wrap up, any final nuggets of wisdom to send them off on their investing journey?
Remember that investing, like anything worthwhile, is a journey, not a destination. Embrace the learning process, stay curious, stay informed, and never be afraid to ask questions.
That's such great advice. And one last thing, our deep dives are just the beginning. Take what you've learned here, do your own research, and build an investment strategy that feels right for you.
Exactly. Investing is a powerful tool for building your financial future. So go out there and make it happen.
That's a wrap, everyone. We hope you enjoyed this deep dive into monthly dividend investing. Until next time, happy investing.